Let's talk about the 6 steps to financial freedom. Step number 1 is creating a budget, finding accountability. Step number 2 is save 3 months of reserves. Step number 3, let's pay off your debt. Step number 4, let's max your 401k. Step number 5, let's contribute to a post-tax retirement account. And step number 6, then you can pay off your mortgage. Let me dive into these just a little bit deeper and give you a better understanding for what I'm talking about here. Step number 1, setting a budget and finding accountability. With your monthly budget, usually I recommend you print off your bank statements and do a 3-month average. There are a lot of banks will have an online where you can categorize everything and it'll automatically work your budget for you. That's perfectly fine. Whatever it takes for you to go back about 3 months and get an average for what you're spending for each item is what you need to do. And I guarantee you when you go through that, you're going to have a lot of light bulb aha moments, right? Where you're going to realize that you're overspending on some things, you need to cut some things. You will definitely find some areas to improve your budget. And when I say finding accountability, what you do is you find a friend or a dear trustworthy mentor, someone that is worthy of being your mentor. Now, you see a lot of times guys will find the guy that works next to him in the factory and he's got the brand new truck and his wife's got the kind of like Escalade brand new edition. They've got a boat, they've got jet skis, and they've got a camper and 4-wheelers and side-by-sides and a motorcycle. Listen, guys, I see this enough. That guy is usually probably flat broke or he inherited a bunch of money some form. So listen, when I say find a worthy accountability partner, find someone that you can rely on with your finances that's making good financial decisions. Somebody that has money in the bank, somebody that's following these steps, somebody that's kids are doing well. You got to look at the whole entire big picture. That's enough on that. Just find a worthy accountability partner. Step number 2, you're going to save 3 months of reserves. This is probably one of the toughest steps because a lot of people, if you're struggling to get by, then you can't even fathom the thought of saving money. But you have to start somewhere. The reason you want to save first is so that when life happens, not if life happens, but when life happens, you're going to have money in your savings account to fall back on and you don't have to go back into debt and hit your credit cards over and over. You know, they say less than 10% of Americans have 1 month's worth of living expenses in the bank account. You got to live like no one else today so that you can live like no one else tomorrow. But save 3 months in a bank account, and whatever 1 month is, for example, if you're living off of $5,000 a month, you need at least $15,000 a month in the bank account. I recommend putting that in a high yield savings account of some sort and put it in another account that you don't touch, that you don't see, and just forget it's there because it's too tempting to spend that money, right? Step number 3, once you set 3 months aside, you got your budget, you got an accountability partner, someone that's working with you, then you want to start getting aggressive paying off the debts. I recommend the snowball effect. You can Google it, where you snowball your debts. You pay off the smallest ones first. I say pay off the one with the highest interest first, usually with the smaller payment. If you were paying $100 a month to this credit card, once you pay it off, then you were paying $100 on this one and you're paying $100 on another one. Now you got $200 a month to start attacking another credit card. Start small and then start snowballing, and it will grow and grow over time until eventually you get debt free. Now, a lot of people have student loans nowadays, and I want to talk about student loans because it's tough to pay off all your debt plus student loans. You need to know what the interest rate is on student loans. Most people don't even know what the interest rate is on their student loan. They don't know how many years of a term they're paying it off. They don't know how much interest is going to occur by the end of that period that they're going to have their loans paid off. If you have student loans, take a deep dive into it. A lot of times when I pull credit, somebody may have 10 different student loans, but they think they're only making one payment because they're paying one company. Consolidate your student loans into one low payment. Check the term, check the interest rates, and make sure you're making a wise decision with those student loans before you start getting aggressive paying them off. But most people would be shocked to find out the true terms of what their student loans actually costing them. Enough about that. Number 4, max out your 401k. A lot of people will tell you to max out your employer's contribution and that's it. Just pay what your employer, match what your employer is matching, and then stick the rest of it into another type of account. I don't care what you do with it. Just know the ins and outs of your 401k. Most people do not know their 401k options or their retirement plans, depending on whatever company you work for. Dig into that a little bit deeper. The reality is when you sign all the big old stack of paperwork, when you start with an employer, you're signing 401k, you're signing health benefits, and you don't understand any of that. Pause. Let's take a minute, fire off an email real quick to your HR person and ask them who manages the 401k account. Your HR person that helps you sign up with the company, they know absolutely nothing about the 401k or the investments or who's managing it and that kind of stuff, but they can probably point you in the right direction. Ask to speak with your funds manager, your account manager, whoever's managing your 401k. Look at the money that's in it. Look at how much it's yielding you. Find out the terms of withdrawal, because I think you'll find that a 401k is very limited, and that's why a lot of people will say only match what your employer is matching up to, because that's kind of free money. Everything above and beyond that, put it in a different type of account. And that's because if you ever go and need to withdraw that money from the 401k, they're going to penalize you heavily. Well, it doesn't make sense because it's your money. Who are they to tell you what to do with your money? But guess what? They are going to tell you what you can and cannot do with your money if it's in a 401k. Enough about that. Step number 5, contribute to a post-tax retirement account. This is after you get paid, you've already been taxed on that money, then you start to invest that money. You can invest it in individual stocks, mutual funds, money market accounts. You can invest that money into Roth IRAs, traditional IRAs, whatever you want to. A good financial planner can help you with that, or if you want to self-manage your own money and don't want to have to pay a financial planner, most of them charge about 1% of your money. So if you got $1 million in the bank, they're going to make about 10 grand a month off of, or a year, about 10 grand a year off of you. But a good financial planner, he's making you money, so you're not worried about that 10 grand that he's costing you. So just make sure that you're being wise with your money, and depending on how long it is before retirement will determine how risky you want to be with that money. If you're young, you may be willing to take a lot of risk with your investments and buy individual stocks. If we're going to be retiring in the next 10 years or so, you're in your 50s, you probably don't want to be as aggressive and as risky with your money. You want something that's going to be a little bit more stable. Get with a good financial planner to talk you through that, or educate yourself and do it yourself. Step number 6. A lot of people do step 5 and step 6 together, hand in hand, but then you can go pay off your mortgage. That's step number 6. Let's get completely debt free. That way, by the time you're retirement age, you don't have any debts, you got some money in the bank, and you can live a comfortable life. Those are the 6 steps of financial freedom.